Thank you all for joining us today for our new era of ESG disclosures within the Asia context. My name is Bhavin Balakrishnan. Just before we get into the content, let me just have some housekeeping rules. Please note that you are free to use the information from this event, but do not quote or have any affiliations towards today's speakers. Please also note that today's session is in recording and the recording is in progress and will be uploaded to our ERM APAC YouTube channel. And thirdly, active participation is encouraged. So note that the Q&A function is live. So please do drop in any of your questions. And finally, we do want to hear from you. So please do share your feedback to the 2 email links below, especially if you're having any specific questions to your case studies or companies. Swiftly moving on. Today's agenda is really around the new era of sustainability disclosures, as we mentioned. And in order to understand that, after this welcome and introduction, we'll be talking about the convergence of these standards, highlight a specific hot topic around nature and biodiversity led by the TNFD conversation, also bringing that to a more global context by looking at the European regulations and the impact of those for Asian countries, summarizing that through our guest remarks, and then closing out the webinar today. With me, we have 4 other speakers, 3 in-house ERM subject matter experts, and our guest speaker going to provide his guest perspective. Just before we get to the content, I want to highlight and provide a baseline of the current market trends and what we're hearing from some of our client conversations. In our work with the UN Global Compact, we found 6 steps to reporting success. The first one is to assess where you are now and understanding how your company is either performing or underperforming with your peers, and assessing your maturity along the ESG journey. Secondly, to better understand that is identifying what is material for your company by conducting a materiality assessment. And in order to prioritize this key ESG topics is understanding and refining the ambition levels from the ESG topics that you've highlighted through your materiality assessment. In terms of the next steps after that, you'll be looking at how you'll be calculating or gathering that information and who you'll be reporting to. And for that will then lead to the communication piece around reporting. Moving on, we're looking at how or what the conversation is from our client perspective, or seeing what the sentiments are within the markets for these new ESG disclosures. One of the main concerns or updates is really around the convergence of standards, and more or less identifying or highlighting the similarities and differences between these standards, and also understanding the convergence between ESG and financial data going forward. One question that we keep receiving is how to go about operationalizing this, especially as a company or an entity becomes more mature within their ESG journey. And a key word to understand with operationalization is integration of ESG within your entity. A key solution in that is digitally enabled solutions. So not only digitalization of your data collection and annual reporting, it's also through understanding how to go about digitalization of your processes and your procedures. This we've found has brought up cross-function collaboration and interactions across different departments that didn't necessarily exist previously. And what that all helps to do is the assurance and verification stage, where data is crucial to track, manage, and disclose a company or an entity's progress. Secondly, assurance and verification is mostly around processes and procedures in this day and age. So ensuring those day-to-day tasks are embedded within the company with a layer of governance is critical during this transformation. Now we'll spend some time diving deeper into the convergence of standards, and I'll hand the mic over to Sina.
Thank you, Pavan. Thanks for the lovely start. Good afternoon, and really nice to see such a huge interest from the audience. My name is Sina Dabral. I am an associate partner with ERM. I'm based in Singapore. And in my role, I support both corporates and non-corporates on their sustainability journey, including ESG strategies, understanding climate change-related risks and opportunities, and on various standards and frameworks and how to disclose around these. And I've experienced doing that in multiple regions for multiple sectors, hence my interest in presenting on the convergence of the new standards and what that means to us in Asia Pacific. All right, starting off, so given the fast-paced, ever-changing landscape of sustainability reporting, as well as public commitments to achieve carbon neutrality or net zero goals, there has been this increase in sustainability reporting requirements by regulators across jurisdictions, including Asia Pacific. And hence, it's become important for companies to keep themselves updated on both local requirements as well as global standards. And this specifically applies to firms whose operations span regional and global geographies. And more interestingly, this fast-paced ESG disclosure landscape is now moving towards financial reporting equivalent. And that's what we will speak about a bit more in detail later on. So if you look at the slide, IPCC, or Intergovernmental Panel on Climate Change, was one of the very first ones to start publishing research papers. The Kyoto Protocol came in after that, and things only started moving in the 2000s with commitments in Europe, wherein companies could voluntarily disclose on their sustainability journey. Come 2010, sustainability reporting and disclosure became one of the fastest growing type of non-financial reporting. And today there are over hundreds of sustainability reporting standards, frameworks, industry initiatives, and hence standardization of these frameworks in 2023 has been a huge step in making things easier. In ERM, we do strongly believe that businesses should prepare themselves to respond to this increase in ESG-related reporting requirements, maybe from regulators or from investors. And again, if you're prepared well in advance, there is also a competitive advantage for you. In the next slide, we'll see that convergence of accounting and sustainability standards has been really quite significant development in ESG reporting. The ISSB, which is the International Sustainability Standards Board, announced the release of the first two standards, which is S1 and S2, IFRS S1, IFRS S2. IFRS S1 sets out requirements for disclosing on information related to sustainability-related risks and opportunities that could be expected to affect your company's cash flow. IFRS S2 sets out requirements for disclosure of climate-related risks and opportunities that could affect your company's cash flow, access to finance over short, medium, or long term. Assurance in sustainability reporting has become increasingly important as many stakeholders and investments would like the sustainability information that they can rely on and trust, and hence this has been incorporated as well. What this slide shows here is that the ISSB has built on the work of investor-focused reporting initiatives. So CDSB, the Task Force for Climate-Related Financial Disclosure, which is TCFD, the Integrated Reporting Framework, SASB standards, and GRI, of course, complementary to these sustainability-related disclosures. And with the advent of TFND, which is Task Force for Nature-Related Disclosure, we also see that emphasis on biodiversity. So these standards, IFRS S1 and S2, what they do is they address disclosure requirements related to an entity's governance strategy, risk management, and sustainability-related metrics and targets. And it's an important milestone in standardization of this global sustainability reporting, not from the intent of sort of improving on the ESG standards or aligning, but most importantly, to make it easier for investors to make decisions because that's the financial angle to it. It's expected that IFRS S1 and S2 will inform many local jurisdictions to adopt or refer to these, and we'll speak to that in the next slide. So we see a growing focus on sustainability reporting by regulators across jurisdictions in Asia Pacific, with with this reporting being implemented or planned to be implemented, there is also an increasing use of TCFD for climate reporting. Hence, we do think that firms should be closely monitoring on when the countries that they operate out of adopt these ISSB standards, and also evaluate implications for their operations in these countries. What we've tried doing in this slide is that we've created a scale of different stages of adaptation of the new standards by various jurisdictions. Voluntary is where there is no mandate to disclose, but good to have. Some jurisdictions are partially aligned or referenced. So one thing to note is that these are the expected mandated regulations as of this week. And this can easily change once countries make up their mind next week or the week after, because it's still in a limbo. So mandatory does not mean the new standards are mandated yet. What it means is that ESG reporting is regulated, and these jurisdictions have reference to or is partially aligned with IFRS S1 and IFRS S2, which is climate-related disclosures. Singapore is among the first in Asia to propose mandatory climate reporting for non-listed companies in line with the new standards. So if implemented, Singapore-listed companies will disclose in line with IFRS S2 by 2025, followed by large non-listed companies from 2027. Hong Kong Exchange has become one of the first to announce plans to align ESG disclosure requirements with the ISSB standards. And there was talks on launching a public consultation earlier this year. In Japan, the ISSB and the Sustainability Standards Board of Japan, which is SSBJ, they have been working quite closely for the domestic development of ISSB standards. So quite a domesticated approach. And early adoption could be permitted starting April 2025. In Malaysia, we see that discussions are ongoing on adopting the ISSB standards, and these discussions are between Bank Negara Malaysia, the Security Commission, Bursa Malaysia, Malaysian Accounting Standards Board. Not on the list here, but in Taiwan, they've announced plans to enhance sustainability disclosure among its listed companies, and plans for future alignment with ISSB standards. In Australia, the Commonwealth Treasury is currently working on implementation of mandatory climate-related financial disclosure standards for Australian companies. And these could apply as well as the financial year 2024 or 2025 for large corporations. So we are seeing a lot of excitement here, and the messaging is that corporate sustainability-related reporting is here to stay, and now this reporting needs to be financially aligned reporting. All right. In the next slide, we'll see that given all these changes, it has become more important than ever to structure your conversation around sustainability-related financial disclosure with your management, with the board, with external stakeholders. The focus is on financial disclosure, which means that focus is on investor audience. And hence we see these standards address disclosures related to the entity's governance, strategy, risk management, and sustainability-related metrics and targets, which is also sort of the core structure of TCFD and TFND. This structure forces companies to think about practical actions, such as developing your strategic roadmap on implementation, or incorporating these risks into your enterprise risk management processes. The overall message here is that integration of ESG into business strategy, into your risk management processes, and using that for performance measurement and relevant disclosure can really drive sustainability into your business. You'll be able to mitigate ESG risks, bring cost savings in, turn ESG risks into new opportunities that in turn create long-term value. A critical part of this reporting is biodiversity-related disclosure, and there's a lot of buzz around nature-positive solutions, for which I will now hand over to my colleague Yasuhide. Over to you, Yasu. Thank you.
Hi, thanks, Sina. So my name is Yasuhide. I'm a partner at ERM Japan. I cover what is increasingly being called the nature-positive space, but also lead our regional efforts on nature and water issues related to business in the region. So I'll be talking about mostly on the TNFD, which I'm guessing you all have heard about already in some form or another. But just wanted to first touch on why nature is so important, why nature positive is becoming a buzzword. So recent studies have shown that about $44 trillion of economic value that we generate globally in a year, which pretty much accounts to more than half of the total global GDP, actually, is dependent on nature and the goods and services that it provides us. So if we didn't have a healthy functioning nature, we'll pretty much lose half of the economic value that we all create globally. So if this ecosystem declines in some ways into a less healthy state, it will maybe, if not all of the half of the GDP, but it may lose up to about 90 or up to 200 billion US dollars by 2030. Or on the other hand, if nature's smart policies are put in place, it would increase the global GDP to the order of maybe 50 to as much as 150 billion US dollars. And if rechanneling of investment funding to nature positive outcomes are done, and then this can really create new business opportunities by $10 trillion annually, or 400 million jobs by 2030. So it's really a good, and it should be a good investment for all of us to make. So where should we making those investments in? On the risk mitigation kind of side, it will be to first prevent supply chain disruptions, obviously, and then avoid regulatory restrictions and costs that really works against nature positive. Maintaining social license to operate is always important, especially when it comes to nature business interface, but also looking at the opportunity side, can really invest in expanding into new market opportunities that brings in nature positive into businesses. Enhancing value propositions, employer attractiveness is always nature goes hand in hand with nature positive. And finally, reducing operating and funding costs that nature positive opportunities can bring is very a good business decision. Moving on to the next slide. So how is it going to go about with nature positive? We can look at how the carbon agenda really came in and landed with businesses and the decision-making process. So climate has the Paris Agreement as the overall global treaty that sets the tone and ambitions. Nature, we have the Kunming-Montreal Global Biodiversity Framework that was adopted at the Convention of Biodiversity COP last December, almost a year ago. The overall global target for carbon is 1.5 degrees, as you all know. For nature, the agreed sort of goal is what's called 30 by 30, meaning that nature needs to be conserved 30% on land and 30% on oceans needs to be protected. You all know the TCFD, but TNFD, the Task Force on Nature related financial disclosure, the guidance has just been released a couple weeks ago. And then there's also the momentum to really aim for a global ambition for carbon. It's net zero. Nature, as I've already been referring to, is nature positives, meaning that whatever business activities that take place or economic activities, eventually we wish that would actually generate a positive net effect on nature. Yeah, and then metrics for carbon. We've been measuring carbon with what's called the scope 1, 2, and 3 throughout the supply chain. For nature, that's also true, but it's more focusing on the impacts and dependencies because traditionally businesses have really looked on the impacts that business activities have on nature, but it's becoming more clear that also business do depend on nature, and the state of nature does affect the sustainability of businesses. Finally, if we look at the scale, carbon obviously is global a scale at global scale. Nature is also a global issue, but one of the characteristic of nature is that it's really location based. So even if you're using same materials, the impact on nature really would depend on where it's coming from, even if it's the same material. So it's a very place-based, location-based approach that nature is taking. But the overall framework, especially for disclosure, follows this the TCFD framework of governance, strategy, risk management, and metrics and targets, which is also same for TNFD. Next, please. So if we look into the TNFD framework a bit more in detail, you probably know that companies are expected to report and disclose on nature-related risks and opportunities using this new framework. It's also worth noting that most likely the TNFD will be feeding into some of the other integrated disclosure schemes, some that Sina has mentioned earlier. So TNFD is really becoming guidance for nature-related risks and opportunity assessment. So again, what is unique about TNFD? It's what's called the LEAP framework: location, evaluation, assess, and prepare. So we're calling it the LEAP, and this specifically caters to the characteristics that I just mentioned earlier on the relationship between nature and business, where it's really depends on the location. So same material, different location, different impacts. So it's very important that companies do trace and understand and locate where their business impact is taking place on the surface of the planet. And that is one of the key features that are highlighted in the TNFD LEAP framework. So within this LEAP, L is obviously one of the most important steps, which will enable you to identify where your business or financial investments are physically impacting nature or relying on nature. But then the E, the evaluation, will identify what are the types of ecosystem that's are in relation with your business, what kind of environmental assets and ecosystem services that your business is relying on, and how much impact that it's giving to in that location. So that will be especially the locate and evaluate section. Then A, the assess becomes a bit more complicated, as it requires for companies to do a scenario analysis, meaning that you need to look at what would happen to your business, what would the risks might be when such state of nature changes over time. It may go into a positive direction, or it may continue in a deteriorating direction. So company needs to take into those scenarios into account and come up with a long-term strategies on how it would respond to those scenarios. And that's what typically what the investors want to know. Just like just like they are asking on the carbon journey with TCFD. Next page, please. And after that, the final part is the P, to prepare. You operationalize it and report on it, which also is sort of similar to the TCFD process. But after you go through this leap, you really need to report on those. And again, I think we already mentioned that it does follow the TCFD disclosure framework, which is the governance, strategy, risk, impact management, and metrics and targets. So for that, many of you, I think you're already familiar with it through TCFD. But of course, nature is very complicated, very diverse. So, each sector may have a very different feature on how it impacts or interrelates with nature. So TNFD is coming up with what's called a sector guidance, especially for impact-heavy industries like agriculture, forestry, fisheries, or energy mining extractives. So look out for that, and that should very much help you go through this rather, unfortunately, have to say, a complicated process in identifying your risks and opportunities and the impacts that it may have. Finally, some industries may already have a lot of know-how and data on your nature relationships, but some may not, especially when it comes to supply chains. Many of the interface with nature is up in the very beginning of the supply chain. So that's something that you probably would need to work with your suppliers and working also with experts who knows the nature on the ground. So with that, I'll hand over to our next speaker. Thank you.
Thank you, Yasu. Hi, everyone. Honor speaking here. I'm a partner with ERM based in Frankfurt, Germany, today speaking to you from London. I'm going to talk about European regulations and how this is impacting the Asian companies. With the next slide, probably would be good to give you an overview of this acronym soup, how I call it. We've got too many acronyms, some of which are here just for documentation purposes that you can go back and look at those when the time comes. But the biggest initiative that the EU is driving is the CSRD, which stands for Corporate Sustainability Reporting Directive. And this is all about sustainability-related disclosures, which also cover the EU taxonomy, which is on the right-hand side bottom, which is a classification system for economic activities to define what is sustainable, what is not, and it's more meant to be a proxy to use for investors in financing economic activities. Secondly, we have financial market participants, as the EU legislation says, which are banks and private equity-like investors, but also pension funds and insurance companies. Those three are pretty much in force right now and in different stages of implementation. On the other hand, we also have the Corporate Sustainability Due Diligence Directive, the CSDDD, which is upcoming and is going to be requiring and focusing on the supply chain of companies that are operating in the EU or are headquartered in the EU. So I leave these different disclosure-related requirements as an overview with you, but these are all called by the EU as the legislative framework of the EU Green Deal. And the EU Green Deal itself, if you hear about it, it's about EU's response to the overall challenges and the political agenda right now globally to make EU climate neutral by 2050, but also securing supply of energy and critical raw materials, as well as responding to other challenges as well in globally, that are relevant for the EU. If we could switch to the next slide, just to give you the way how it looks like in terms of sustainability disclosures, I mean regulated sustainability disclosures in the EU. On the left-hand side, when it comes to the ESG sustainability type of disclosures, we had the non-financial reporting directive. Now it's being replaced by the corporate sustainability reporting directive, as you see the new reporting regime. And the CSRD is relying pretty much, get ready, the new acronym, on the European Sustainability Reporting Standards, which is the ESRS. So the CSRD lays out the foundation of who and when should be reporting. ESRS lays out the foundation of what should be reported. ESRS is drafted by EFRAG, which is the European Financial Reporting Advisory Group, and CSRD is the regulation coming from the European Commission. And these are all bounded by the EU taxonomy regulation, which is required by the non-financial reporting directive, as well as the CSRD, the corporate sustainability reporting directive, to be included, as I meant earlier, as a proxy for investors to use on what activity, economic activity, is deemed to be sustainable and whatnot. So let's deep dive a little bit with the next slide on the requirements of the CSRD. CSRD requires a double materiality assessment as a starting point to look at what should be reported. The double materiality is a new concept which combines the GRI type of materiality understanding, focusing on the impact of economic activity, and the SASB type of investor type of materiality assessment on financial impact of things on a company. So this is a new concept that is being pushed by the CSRD, and we believe it's going to have an impact on materiality approaches globally. But today we know that the ISSB standard, which has been mentioned earlier, it rather follows the financial materiality aspect. So running a double materiality based on this definition is key in starting for any company to understand what ESRS metrics, how many of the more than 1,400 KPIs should be reported by a company. So on the next slide, I'm going to give you a little bit more detail on the regulatory timeline on reporting, and this is in comparison to the SEC and ISSB standards. Now, ISSB standard is very much dependent on, we've seen in the previous slides, on adoption of different regulatory authorities in different jurisdictions, whereas SEC is coming from the US and it's going to be a US initiative in regulating which companies should be reported by when. If you focus on the CSRD reporting, those companies that are under scope of the NFRD will be reporting in 25 based on 24 data. Those companies that are under scope of the NFRD means those public interest entities in the EU, so mainly listed companies. So it's about 10,000 companies. The big change is going to be in 26, where companies will have to report on their 25 data, and that's going to be about 50,000 companies that are operating in the EU, so 40,000 more companies. And finally, those non-EU companies having substantial business in the EU will have to report in 29 for their 28 data on a group level. So they will have to report on their global operations, meaning for majority of APAC companies, Asian companies that are operating in the EU, there will be a stage-wise implementation requirements. First of all, looking at the EU operations for 25 to be ready, beginning of 25 to be gathering data, and secondly, on 28 for their global operations, meaning the CSRD is going to globally is going to be coexisting with all the other things that have been mentioned today and requiring companies to report both on CSRD and any other required reporting regimes in given jurisdiction where they operate. Next slide, please. So in terms of preparing for understanding when you should be reporting for those companies I'm speaking of, in what jurisdictions. It's key to run through this right-hand side flowchart to understand when you will be, falling under scope. I mean, it's about either in 25 for 24 data, and then stage-wise in 29 for 28 data. It's key to first look at, when do I need to do this? When do I need to report? And then design based on this. Next slide, please. The 5 key steps. It is important to look at it. Okay, here I'm going to report on these operational sites, and go backwards and make a project plan based on when you need to report. So doing that project plan, it's about operationalizing your sustainability disclosures, and it's not a simple task. We believe from stage 1 to 4, it requires about 2 years. If you think about the first requirements to report in the EU, starting from fiscal year 24, we have about 14 months time left. So it may be that there is a liability risk and some compliance fee risks coming from different jurisdictions in the EU if the things are not done right. If you focus on the discovery stage, as I mentioned earlier, it's about where do I have to report and when? Secondly, what is material for my business? Basically running the materiality assessment. And thirdly, looking at where do I have the gaps? The design stage pretty much focuses on also, okay, these are the data that I need to report, but do I have the data systems in place? Am I digitally well equipped to gather data from different sources like, company workforce, supply chain, own operations, and where am I missing the data? And when it comes to implementation is key and pretty much disregarded, but it needs to be integrated into site level operations, meaning management systems and process controls need to be updated. And most importantly, this is about change management. Personnel need to be upgraded, and they need to go through trainings to be able to deliver this. And it is not over by just reporting, which also needs to meet assurance requirements, so that the whole thing needs to be designed in a bulletproof way, because your auditor is going to be questioning every stage of it. It also needs to be enabling a transformation exercise, because when that whole data is out there on the market, people are going to look into this, because EU is running for full transparency and will gather all the data out on a European database where legislators and as well as activists and shareholders are going to look into this. So it's key to put out a program to continuously improve performance and transform your business into a more sustainable business. So the next slide is going to be my final words on the connection on how this relates to the sustainable finance developments. I mentioned earlier the SFDR. SFDR is a framework setting out different types of investment products, financial products. They can be labeled as Article 6, 7, 8, light and dark green, and 9. Do not focus on these names, but just broadly speaking, from Article 6 towards Article 9, financial products are required to invest into certain companies or finance certain activities that are more sustainable. So towards, if you go the ladder up, the more sustainable the products become. And that puts requirements on companies additionally to implement more sustainable approaches, disclose more, and show evidence. So it's not about principles, but it's all about showing evidence on how companies are moving towards more sustainable operations. I would like to pause here and switch to my next colleague, our speaker.
Thank you very much, Onur, and thanks, ERM. My name's Joe Phelan. I lead the work of the World Business Council for Sustainable Development in Asia and the Pacific. You can find me on LinkedIn. We're a community of more than 230 large companies, including ERM, and including more than 50 from across Asia and the Pacific. And we're a community who work together to avert the worst impacts of the climate emergency, of nature in crisis, and of mounting inequality. And what we see is that sustainability has gone mainstream and the world is turning to business for solutions. And all companies are expected now to do two things. The first is drive transformative solutions into your value chains using science, data, and collaboration. And the second is to embrace accountability. And that's tough for all of us all the time. But really, there's no alternative now, and that's about embracing accountability for our climate performance, and soon for our performance on nature and inequality too. And that's because accountability is how sustainability gets done, and accountability is how anything gets done in business. So at WBCSD, we run platforms to help companies create and implement those collaborative solutions in their value chains. And we help businesses to navigate the corporate performance and accountability system for climate, helping them with the frameworks and the regulations, but also looking to strengthen that system where there are gaps in it. So, for example, we co-convene the Greenhouse Gas Protocol, which is the standard for measuring and disclosing your greenhouse gas emissions performance. There hasn't been a framework for an effective framework for Scope 3 emissions, so at the moment we're developing that, for example. I've been asked to make some remarks about the trends in sustainability disclosures and what that means for business, and also to speak a bit about this is necessarily a compliance subject. We talk about accountability, but also a little bit about it is a transformation opportunity, and maybe some things I'd say up front is, and it's clear from the people on this call, what we see is that when businesses join calls like this or start working with WBCSD, the first thing is that people, they discover they're not alone. Everyone is working with the same problems, and also this agenda which is driving us, coming really fast. By working together, we can start to shape it a bit, get ahead of the agenda, start to shape it a bit as well. There are opportunities in collaboration. So we've heard a lot about these standards already, so I'm just going to draw out some implications, some trends, and also highlight some examples that might be useful for you. So on the ISSB, which we've heard about in detail, I think the main thing to highlight is that this now requires sustainability information to be treated the same as financial information. And what that means is increased coherence, so being able to explain the link between your sustainability performance and your financial performance. The second requirement is simultaneous disclosure. Sustainability reports used to come out a long time after financial disclosures. They now need to come out together, so because sustainability performance is linked to financial performance. We've heard already, and just now from Honor, much greater needs for increased capacity, larger teams to understand, measure, and understand frameworks, measure performance, and disclose it. So certainly increased capacity, but also increased expectations of CFOs, of audit, of risk teams, of investor relation teams, internal controls, much greater expectation on existing teams for understanding ESG metrics as well as traditional financial performance. Increased data needs, especially on Scope 3. We can anticipate strong data needs in the nature sphere to follow. And lastly, better decision making, because we're running after sustainability standards and frameworks, but really what we want is better decision making, and that means for business a really strong focus on materiality, so that we're measuring and getting good information, decision useful information on the subjects that are material to managing our business. And for finance, that means comparability, so that they're able to compare performance between different businesses and make investment decisions accordingly. That's ISSB. If we look at CSRD, and I would include all the frameworks coming out of the EU and also the Inflation Reduction Act in the US, because really what these are, a new phenomena or a much more heightened phenomena of trans-jurisdictional policy making and policy impacts, whether that is the attraction of the Inflation Reduction Act to investments in the US in clean technologies, or the need to comply with different regulatory frameworks in the EU, even though you're not operating in the European Union. We heard that the key thing with this CSRD is a double materiality framework. It's believed that it will bring penalties. Non-compliance will bring penalties for companies in terms of worse credit ratings or even delistings, but also potentially impacts for territories if there's consistent non-compliance that could affect the trade relations for countries. CBAM, the Carbon Border Adjustment Mechanism, where if you're importing to Europe from a different carbon regime that doesn't have similar carbon pricing, you could pay a border adjustment tax to compensate for that. Already, some businesses are gearing up for this and have signed power purchase agreements where their energy source switches to clean technologies as their sector comes under CBAM jurisdiction. So, and these companies are seeing this as a way to compete and win market share. The CSRDD will put a big, it's due diligence, so it puts a big responsibility on companies to know this concept of due diligence, where you are responsible for finding out whether it's on human rights or other aspects of your supply chain. So a lot of extra responsibility. And of course, TCFD and TNFD, which have seen a lot of uptake, especially TCFD with Japan out in front. I want to share a bit about the concept of valuation. We heard about understand climate and nature-related risks and opportunities and creating long-term shareholder value. This is what we talk about in sustainability. Our vision ultimately is that finance will flow to transformation, and the companies that perform best on sustainability will attract. And together with our members, we're doing work to understand whether this is happening. And I just want to share a few things on valuation with you. The first is actually data from TCFD itself, which shows that, and there are many different methods for assessing this, and different financial institutions are using different techniques to do it. And it's early days, but there is directional evidence that climate risks are showing up in pricing. They're showing up more in insurance pricing than in investment pricing. They're showing up more for short-term transition risks rather than medium or long-term physical risks. That's in part because physical risks are harder to quantify, including the time horizon for them. Businesses are using different proxies, but there's also evidence that higher emitting industries are attracting a higher cost of capital through things like shorter loan maturities, requirement for higher collateral. And there's also very clear evidence that well-articulated climate scenarios, target setting, and communication on performance is resulting in better credit rating for companies. WBCSD has done some work to build on this and really look at the upside of valuation on sustainability performance. So we've just produced a report on the integration of sustainability in valuation, which does two things. It sets out a framework of what a valuation model could look like that factors in sustainability metrics, but it also highlights some practical examples from financial institutions valuing companies based on their sustainability performance. And just for example, there are 9 case studies in the report, but UBS see a 25% upside in Heidelberg Cement if it meets its emission reduction targets, and that's due to the emission trading scheme in the EU. Aberdeen is looking at how credible climate scenarios impair and enhance the valuation of Honda, Kia Motors, CRH, and Saint-Gobain. WHEB has looked at how sustainability in the semiconductor industry can have big upsides in valuation there, particularly within Infineon. And lastly, there are 9 case studies, but lastly, Edison Research evaluates how Mytilineos could profit from the energy transition growth reflected in upside valuation potential. We're always looking at risks. We're always looking which need to be managed as a business. it's uncomfortable disclosing financial risks to capital markets, and it feels like a compliance game and a game with downside. There is evidence of upside too in better target setting, disclosure, and management of sustainability related factors. So I just share that with you. I will finish with some some resources and some things you can follow up on. So I talked about data and the challenge of scope 3, and according to where you all are on your sustainability journeys, you're either really struggling to get your head around how you're going to measure your scope 3 emissions and decarbonize your scope 3 emissions, or that pleasure awaits you. Our approach at WBCSD and with our members to addressing this and filling this gap is something called the Partnership for Accelerating Carbon Transparency. And we've developed this as the international standard for product level carbon footprinting based on primary emissions across a supply chain. So if you are starting to look at scope 3 emissions, I really encourage you to look at that. Secondly, in nature, TNFD is around disclosing your nature-related financial risks, but it's also important to look at your business and how to align your business with nature-positive outcomes. And we've produced 3 nature-positive roadmaps for agri and food, for the built environment, and for the energy sector. And these give guidance for how these 3 sectors, together representing 90% of all impacts on nature, how these 3 sectors can align their business with nature-positive outcomes. So I commend those to you. Thirdly, every year we do a study of all of the disclosures of our member companies around the world. It's called Reporting Matters. Just to highlight 5 examples from Asia that you might want to look at, 5 examples of good practice. So CP Group in last year's study are an excellent example of completeness of disclosure. Patronus and DBS, both excellent examples of stakeholder engagement. Swire, excellent example of internal performance controls and governance, and Bridgestone, excellent examples of target setting and commitments. 2 final reference points for you. Our Redefining Value project is aimed at, this year we'll build business cases for sustainability to equip CFOs and others with evidence to be able to make investments into new sustainability models and operations. We're building the capability of CFOs and supporting them in capital market engagement. So their capabilities to manage ESG and to do better capital market engagement. And finally, we're running preparer forums for all of our members for them to identify and develop the governance and management capabilities, systems and processes needed to respond to and manage their disclosures against the ISSB. So that's it from me. Please get in touch if you want to know more about any of this. And as I said, businesses, we're not alone. There's a lot we can learn from each other, and it is possible to get ahead of this agenda. Thanks very much.
Thank you so much, Joe, for giving us a guest perspective, a third-party perspective. And with that, I'll conclude this with some closing remarks, just to summarize what we've discussed thus far. One thing that we've mentioned a couple of times is sustainability is evolving. It's not so much compliance or health and safety based anymore. And we're really moving on towards higher maturity across different companies. And we're using different ESG frameworks to help us get there. 2 key themes or trends as such that we've highlighted and we want to reiterate for this call is nature and sustainable supply chains. So foresee a lot of conversations on this, and then also subsequently data will follow in order to make those business decisions. Secondly, include your decision making or your makers within the change or transformation process. That's not only your CEOs and CFOs, start involving your board members as well, so that you can have a top-down push. Moreover, once you get involved with the senior management as well, with a little bit more incentive to act, this starts becoming integrated within your organization. Thirdly, is to be prepared with an ESG implementation plan. We've mentioned this a couple of times. We still have time before any of these disclosures either becomes mandatory or has a regulatory timeline. So take that time to make some effort to think about which resources you want to allocate to it. And with a good implementation plan, you will see that the initiatives that follow will help you achieve your targets and also allocate responsible functions in a timely manner. And then lastly, leverage your existing relationships to collect data. There are pockets or silos of information, even with mature companies, for their sustainability reporting practices. Understanding where these pockets of information or key experts sit within your organization, or maybe even across your value chain, is going to be useful for you to quickly and effectively gather this information. And on that note, also digitalization of this data will help you speed up this process even further. And that way you can make more proactive decisions rather than reactive decisions. With that, I want to offer a quick closing poll, and would appreciate everyone's time in taking that poll. And in this time, I'll also take some time to thank our presenters for their time and key perspectives. Please note that there are 3 questions within the poll. So if you do scroll down, you will find the 3rd question. Note that the poll is fully confidential, and so we will not be using this externally with names attached to it. And with that, I will close out this session and thank everybody for joining us. Once you have answered the poll, please feel free to revisit this webinar on our YouTube channel. And also please note that we will be sending an email to our participants with our key resources as well. Thank you all.